Hello and welcome everybody to the High Return Real Estate Show. And I am here with my illustrious business partner, Mr. Jack Gibson. Hello, Jack.
Hey, what's up, Shecky?
How are you, sir?
Doing great.
Good. I'm excited. We've got a really, really amazing guest on, and this is a guy who is going to prevent you from making a lot of really stupid financial mistakes. I can honestly say that Jack and I, even in the few years that we have been together, have seemed to amass quite a few financial mistakes, which have been some really fun lessons. But the guy we're going to talk about today is going to talk about the 10 most expensive tax mistakes that you can make as an investor. So stay tuned. We've got a really, really amazing show for you.
Welcome to the High Return Real Estate Show, the podcast for heavy hitters. Two men, one mission. It's time to build your empire.
And welcome back, everybody, to the High Return Real Estate Show. I'm here with my business partner, Mr. Jack Gibson, and today we have got the great pleasure of introducing Mr. Craig Cody. Hello, Craig.
Hi, Jack. Hi, Shecky. Thanks for having me today. Psyched.
Yeah, I'm psyched too. I want to tell our listeners that if I can brag about you a little bit, I'm gonna tell the listeners how amazing you really are. So I'm just gonna read this off of here because it's so extensive I can't even memorize this. Craig is a CPA, a certified tax coach, a business owner, a former New York City police officer, 17 years on the force. He belongs to a select group of tax practitioners throughout the country who undergo extensive training and continued education on various tax planning techniques and strategies to become as well as remain certified. With this organization, Craig has co-authored an Amazon best-selling book, Secrets of a Tax-Free Life, and there's a really interesting offer that Craig's going to have for listeners at the end of the show. So stay tuned. You're going to want to really listen to this entire episode because I'm excited about all the great nuggets of wisdom that Craig's about to lay on us. So Craig, welcome.
Oh, psyched. I'm psyched.
Yeah. So let's talk a little bit about I'm really curious first about this transition from police officer to, tax guy. I mean, how does that happen? I mean, just get tired of beating up on thugs or what?
Remember, I'm in New York. Okay.
All right.
I was an economics major before I decided to, follow my dad's footsteps and become a police officer. And I was going to become a chief, and that was kind of the goal. And I started to go up through the ranks, and it's civil service, so you have to wait for tests. And all of a sudden, there was like a 10-year window where they gave no tests, and things change, and you get other interests. And somehow, I kind of started liking taxes and learning about taxes and kind of learning about, how to do estate planning and stuff like that. And I decided, okay, I'm going to be able to retire in a few years. I went back to school. I got my accounting degree, and I thought I was going to go into financial planning. I said, if I have my CPA, I would set myself apart from other people. But I actually really fell in love with the numbers and taxes and being able to save people money. So I never made it down the financial planning route. I went to work for an international firm. I did that for a number of years before going out on my own. And, one thing led to another. And, I have a firm now. There's 10 of us here. And we specialize in tax planning for clients. And really what tax planning is helping your client keep more of what they make.
Yeah, it's a great way to frame it. So I want to really dive into this. I mean, you say that there's 10 of the most expensive mistakes. I mean, I'm guessing we probably don't have time to go through all 10 of them, but, I guess the easiest question for us is to ask, what's the most common one that you think people are making?
Well, remember, I'm an accountant. I'm a CPA, so my words, I'm straight and to the point. You can't. I normally have a pocket protector. I'm not wearing that today.
Okay,
right?
Thank you.
So 10 is easy, but the big one is really failing to plan. All right, people go on vacation, they do all this planning. People buy a car or a truck, they do all this planning. They don't want to talk to their tax guy. They probably don't speak to him until it's March or April. And at that point, it's really too late. So if they take some time and they work with the right person and they figure out, okay, how can we save some money? What can we do maybe a little bit differently than we're doing now? You could save significant money.
I'm sorry. So in that planning, you're saying, a lot of it has to do with just really the way that things are structured, the way that entities are structured, the way that deductions are structured, all that kind of stuff.
Exactly. And it's, so many times what goes into an entity, I call my lawyer and he said, you should do an LLC, or he says I should do an S corporation. There's no, okay, let's get our CPA and our attorney together and see if we can have, maybe the best of both worlds. And, more times than not, they choose an entity because that's what the attorney thinks is the best liability structure. But maybe there's a way to get both.
Okay. That's great. So can we roll through then what the other...
Sure.
I mean, is it, I don't know, I guess I'm asking the question again, do we have time? Can we roll?
Yes, we could definitely roll through them real quickly. So
okay.
Number 2 is audit paranoia. Don't think just because somebody tells you you're going to be audited or it's a red flag that you shouldn't do it. If you do it, if it's legitimate and you document it, let the government ask you about it. All right? Let them ask you. It's when you don't document it and you do something, then you got to be worried about the government asking you stuff. So always take the time, and it's part of the planning process, and document what you're doing. All right? Setting up the entity, the correct entity. All right? Should you be inside of an LLC? Should you have multiple real estate properties inside of an LLC? How do we want to have those structures set up? So often you'll see a piece of rental property inside of a C corporation, all right, which normally is not the best way to do it, all right? Mm-hmm. But you should have that conversation before you do anything. So then we have something new, which is missing out on qualified business income, this is a deduction that the government gave you, and you have to be actively involved in the trade or business. And rental properties can qualify. And what this is doing is if you do have a profit and you meet the qualifications, the government is saying, if your profit is $10,000 on that rental property, we're going to give you an extra $2,000 worth of deductions.
Wow.
For something that you don't have. All right. So it's a new law. It's a law that a lot of people are not familiar with. It's a little bit complicated, especially when it comes to real estate. So planning is the way to go there. So you want to be proactive versus reactive.
Yeah. So if you set that up ahead of time, knowing that you're going to try to take advantage of that law, you set it up in such a way that your books show at least that $10,000 worth of profit.
Well, you make sure everything is set up so you could actually take advantage of this deduction that the government is putting out there for you to take advantage of. But if you don't do it right, you're not going to be able to take advantage of it.
Yeah, go ahead, Jack. You got a question.
Yeah, it's, ironically, I just met with my CPA this morning. I didn't even know we were going to get into this on the show today. So this is awesome. And we were going over, all my different entities. Some are LLCs, some are escort, one is an escort. And so, yeah, we got into the conversation about when does it make sense to move from an LLC into an escort to save off, when you distribute profits back to yourself, being able to not have to pay the FICA and Medicare on the distribution. So that was and a lot of things have changed, right, this past year with the Trump law. So do you have any kind of insight on that? When is the right point where income-wise, it does make sense to make that jump from LLC to escort?
Well, it's great that you're actually having that conversation, okay? Because most people aren't having that conversation. Right. And you have to run the numbers. You have to run the numbers when the compliance part of it, okay? The cost of the compliance makes sense versus what your FICA tax. So typically it's FICA.
Compliance is in all the filing that you have to
exactly
do, S corp, and
right.
The accounting fees on top.
Correct. Yeah. Correct. So, and depending on what you're doing, if it's strictly a rental property, it probably doesn't make sense because most rental property is not subject to self-employment income unless you're an active, a professional. Mm-hmm. All right. And then that's a whole nother thing to get into because many people, think they're professional and they're not. So there's a whole bunch of hoops you have to jump through there. But yeah, you have to really just look at, all right, what is the cost of compliance? When should I make this? And are you familiar with that I'm allowed to make actually a late election? The government says you could actually go back 3 years and 75 days and make an election. And there's a couple of hoops you have to jump through in order to do that. But there is, that is an option. All right. So the fact that you're having that conversation is a great thing.
Yeah, great.
Okay.
So another thing we have is the wrong retirement plan. Now, depending on are you a real estate professional or not, may allow you to have a real retirement plan. Hiring your kids, all right? As long as they're doing work for you, you could now under the new tax laws federally, you could pay your child up to $12,000 a year, and they will have no federal income tax. So if you're in the 35% bracket and your kids, basically, you're going to take $12,000. Now you have to document what he's doing. He has to be paid a reasonable wage, but that $12,000 that you pay your kid that he's going to use to pay for tuition or hockey camp or whatever it is, could save you $4,000. And if you have a couple of kids, you multiply that out. Now you have to do it right, right? You do have to pay FICA on it, so that's another thing you have to factor in there. But hiring your kids, medical benefits, all right? Do you have a lot of out-of-pocket stuff? You can set up a medical expense reimbursement plan, which is under Section 105, and you could actually deduct dollar for dollar medical costs, whereas, on your tax return, it has to meet a threshold and, jump through a whole bunch of hoops, and most people are not getting the benefit of that. But, a medical expense reimbursement plan and your kid's getting braces and it's costing you $6,000, now you get to deduct that $6,000 versus not.
Yeah, it's great.
Home office, many investors, work out of a home office. You have to spend about 15 hours a week working out of it. And it has to be, space set aside just for your home office. And you get it to deduct maybe 5%. Let's just say it's 5% of your total space. You get 5% of utilities and maintenance and stuff like that. But then what it does is it opens up travel from your home office to your other office or to your different properties and stuff like that. It also opens up the home athletic facility deduction, which could be your home gym or your pool. So those turn into much bigger deductions.
How do you deduct your pool?
If you have a home office, you could have an on-premises athletic facility and your pool could qualify for that.
Oh, wow.
Yeah, it's kind of a nice one.
We got a big pool in the backyard that, it's a hole in which we pour money.
Right. Well, at least you'd make that money deductible, okay?
It's interesting. I haven't heard that one.
Then we have your car and truck expenses. Most people are aware of that, but if you really don't have a home office and you haven't, it's really hard to deduct that legally. And meals and entertainment. If you're taking people out and you're entertaining is no longer deductible under the new rules, but meals are, 50% deductible. It doesn't mean if you go to McDonald's, you can deduct the Happy Meal. All right. But, if it's a legitimate meal where you're taking a prospective, client or somebody that's going to be buying from you, that can be a deductible expense. So those are your 10 big ones. And, I would say our typical client is saving somewhere between $15,000 and $30,000 a year. And you multiply that out by 5 years and you're talking about, that's a lot of money.
Yeah. So as far as the entertainment deduction, what was the logic behind taking that completely off as a deduction? Like that one, for my companies do a lot of entertaining. So that one hurt for me. Obviously I think they've made up for it in other areas with some of the other deductions. So I guess is that how I need to look at it? Is okay, I can't take this over here, but I'm getting better served over here.
Congress is not logical.
Yeah.
Okay, got it. I'm clear.
Sometimes, well, it was funny because for a while the home athletic facility was out, and then at the last minute was in. So really not sure how they decide on certain things. Basically what they were trying to do is they were trying to equalize for business owners, and I'll call them small business owners, what they did on the C corporations. So your big corporations are typically C corporations, and they lowered the tax basically from 39% down to 21%. So now to pass that out on to everybody else in America, that's where they came up with this qualified business income deduction, Section 199.
Got it. Okay, that's interesting. I'm going to come swim in your pool, Jack, and we're going to call it a business meeting.
Okay.
Well, it's got to be available for you and your employees that work out at home office and their families. So as long as it's available to them, you're good.
Well, you hire your kids.
Is it available for employees, you said?
Well, the employees that use that home office and their families. Yep.
Okay, so what if the employees are just my wife and myself, because we're the employees on the corporation?
Then it's you and your family. Yep.
Okay.
So maybe a minor point, but I've got a question more about, because you were talking about this meal deduction. And, I track all my stuff and I do travel quite a bit. And some of that travel is for business. And I'm on the road by myself. Are those, I know it's only 50% now, but are they or are they not deductible when you're traveling on a business trip?
The reason why they're 50% is because your meal is technically not deductible.
Okay.
Okay. So your meal that you're not having a meal with a prospective client. That's when your meal becomes deductible, when it's at 50%, because you have to eat no matter what. So I would say no.
Okay.
You're saying, so if I go out by myself and, or like you said, I'm not supposed to deduct
Correct.
that?
Correct.
Oh.
Because if you were home, you'd be eating too by yourself or with your family, but it would not be deductible. It's when you take a client out that it's 50% deductible, because yours is not, the theory is your half is not deductible, the client half is.
Okay.
So here's another question, because I know there's probably a lot of investors listening to this now. And, the CPA relationship for a lot of people could potentially be one that they've had for a long time. And, you're bringing up some things that I think not necessarily every CPA knows, because you've gone down this rabbit hole of training and education for yourself, and kudos to you for doing that. But how should an investor be able to have this kind of level of conversation with their CPA? Or more, what I'm getting at is how could they maybe vet that CPA? I'm just trying to get into the brain of the listener right now and go, okay, crap, I'm listening to this Craig guy, and he obviously knows what he's talking about. I like my CPA. How do I run my CPA through the hoops and make sure that this guy or gal knows what he's talking about? Or how do I make sure that, how to get away from him if he doesn't know what he or she is talking about?
Right. Well, you have to have communication. All right. And if you're just communicating with that person around tax time, you're picking the wrong time to really want to communicate with them, because in all likelihood, he or she is hunkered down trying to get stuff out the door. So you should be, communicating with that person throughout the year. As far as vetting, if you're working with someone, I always say, when was the last time your CPA came to you with an idea to save you taxes? And I typically get the kind of glazed eyes. And it's like, no, that never happens. Now, it's not necessarily his or her fault. It might be because you're only talking in March or April. All right. But you want somebody that's not just going to be putting the right numbers in the right boxes. You want somebody that's going to go a step further, show you what things that you can be doing to save you money.
Yeah, and I want to dial back around to something that you said earlier. You talked really about, getting being aggressive with the IRS. This is the words, I'm having a hard time getting them to come out today, and making the onus on the IRS to prove you wrong. Like taking an aggressive stance. So,
well, you don't have to take an aggressive stance. If the code says you can do it, I don't think that's aggressive. I think they're saying you could do it. Now, documenting what you did and how you did it. Okay. So now the code says you can do it. Listen, Trump, Buffett, Gates, they all have teams of attorneys working for them. All right. Most likely you don't have teams of attorneys working for you. Most people don't have that. So you need to document what you're doing. All right. And do it the right way. And then this way, if somebody does question it, well, you have the backup there, and it's easy for you to show, this is what I did, this is how I did it, this is what the code says. So when we put a plan together for a client, we also list the code and the code section that says you can do this, you can do that. But back to your original question, if you don't communicate with your CPA, all right, don't expect 99% of the time that they're going to communicate with you and come to you with ideas. If you're going to that person once a year to prepare a tax return, that's what you're paying them for, to prepare a tax return.
Yeah.
So too often people look at, the cost of their accountant, their CPA as an expense item. And I always say, look at it as an income item. If you go to them and you work with them and you really use their brain and they're the right person, they should be saving you more money, okay? Not costing you more money.
Yeah, that's a great point. And that, go ahead, Jack, you got a question?
I was just going to say, I think a lot of people when they go through as business professionals or whatnot, and then they look at the expense, the check that they just, wrote to their account, like, oh man, I could have done this on H&R Block, or I could have done this with this software on my home computer. But I think what I've found is that, and I did that one year and I ended up making a mistake, and then it cost me much more than, would have just had it paid my professional that was doing them and doing them the right way. So I'm totally aligned with that. I think that, another thing I was going to ask though that came to mind is what are some things that you have seen that maybe could trigger a potential audit, maybe more so? What are the potential, red flag type items? Or
like when it comes to real estate, you see the guy that buys the house for, $100,000, and then it was his primary residence. Then he turns it into a rental property, and at the time it's valued at $250,000, and he starts depreciating it based on $250,000, and he only paid $100,000 for it. So those are things you see. You also see a ton of times where people are not appreciating the property correctly, all right, because they're trying to do it themselves, or they're not planning, they're not working with somebody on a regular basis and figuring out the things they're able to do. But getting depreciation correct, is a big one, especially when it comes to real estate. Getting, if they're financing, if there's financing involved, people thinking, well, I could write off the whole payment. No, you can't write the whole payment off. You can only write the interest portion off. So those are two issues we see a lot with real estate. Then we have people that think they're real estate professionals, but they're working a W-2 job, 40 hours a week, and you need to really be able to prove that you're working on your real estate 41 hours a week to be a real estate pro. And that's not typical.
Yeah, so most of that stuff is people just, stretching what the idea was put forth in the tax code, and, they're taking some liberties that they probably shouldn't be taking.
Right. And then how a big thing is also how you have it set up, entity wise. Is it in an entity? Do you own it, in your own name? And God forbid you get sued. That's, crazy.
Yeah, there's a whole nother conversation about asset protection.
Right.
That could be 4 more hours of conversation. So I've got a couple more questions I want to ask you, but we're just going to take a brief pause for Nicole, who's going to come in and do her thing with Home Run of the Week. So take it away, Nicole.
This is Nicole, your Director of Investor Relations at High Return Real Estate. If you're looking for a way to stay cash flowing, duplexes are the way to go. Why? Because even if you lose a tenant on one side, you still have revenue from the other. That is why they are so popular and why we have such a hard time keeping them in inventory. This particular Oxford Street duplex has a new bathroom, new electrical throughout, new plumbing, new furnace, and much more. Most importantly, all of our properties come fully tenanted, stabilized, and professionally managed, so you are cash flowing from day one. There's so much more to tell you. Just send me an email at homerun@highreturnrealestate.com. That's homerun@highreturnrealestate.com, and I'll send you the rest of the details. Talk to you soon.
Awesome. Thank you, Nicole. And, we're back with Craig. And, one of the things we were talking about earlier, Craig, was the attorney CPA relationship. And one of the things I learned a long time ago was that there's a triad there almost of communication between you, your attorney, and your CPA. And you clearly stated, and I know this is true of a lot of people, and my guys have kind of fallen off because I moved a couple of years ago, and I know I need to rebuild those relationships back up. But how do you develop that triad? Like, how do you get your CPA tax planner guy talking to your attorney? Because it seems like it's nearly impossible to ever get them in the same room, or sometimes even in the same email thread.
Yeah, well, I mean, that you just have to find people that are willing to do it. All right, that is important to them. So if it's important to them, they'll make it happen.
Yeah.
If it's not important to them, then you need to go on and find somebody else that it is important.
Yeah.
Because ultimately, them working together is going to benefit you.
Absolutely.
So it's kind of like my way or the highway, right?
Yeah, exactly. Yeah, and you're the client. You're the one paying them for their services. So, and that's the thing we try to do with our listeners, is just empower them and just say, hey, it's your business. And, you made a comment right before we turned the record button on about, some people that are real estate investors, they just call themselves, I own a rental property or 3. They don't call themselves necessarily business owners, because they may have a W-2 job by day, but whether they recognize it or not, and your point's well taken, they are indeed business owners. And the moment you make that transition to business ownership, even if you have a 40-hour-a-week W-2 job, you're still a business owner. That comes with certain responsibilities. You have to take some responsibility to direct your business in the right way. So maybe a final question, I don't know, but my favorite question, what's the question that we should have asked that we didn't?
I would say, how often are we going to communicate?
That's a great question. And what's the answer?
You should be communicating on a regular basis, whether it's, once a month, a typical business owner, if you want to call, if you're in the business of, rental properties, you should be communicating at least once a month. Okay. You should be looking at P&Ls on a regular basis. All right. Because good information, you can make good decisions with.
Yeah. That's great advice.
And the data is making a decision or whatnot, strategic move based on facts versus emotion.
Right. What do I think is, happening versus what is really happening.
Yeah. Yeah. Really get clear when you can look at the P&L and the balance sheet, and just the numbers don't lie. They're right there. And
right.
That's when you can make, more sound decisions. So I'm with you. That's good advice.
It's amazing too, like how big of a chasm there can be for all of us as business owners between what we think is going on and what the numbers really say are going on.
Exactly.
I don't know if that's just part of the human condition or just being an entrepreneur in general, but it's there's some pretty big discrepancies there.
Right, and sometimes you don't realize how big your expenses are when you kind of sit and look at them and go, "Oh my God, I need to not be paying for all this.
Yeah,
I don't need this."
Yeah, exactly. So I know we alluded to it at the top of the show, and you've got a really, really incredible offer for the listeners of the show, and I want to give you lots of airspace to talk about it.
Sure. So I'm going to give you a free copy of my book, actually a paper copy. It's the 10 biggest tax mistakes that cost business owners thousands. And if you're listening here and you're a real estate investor, you're running a business, and you could get that at my website, which is craigcodyandcompany.com/high return. So we should be able to remember that one. And you guys can put that in the show notes if
yes.
Absolutely.
And you click on the link and we'll get you out a book and take a look at it and discuss it and, put those things into action with your CPA.
And thank you, by the way, from maybe one I'm looking at your gray hair, and maybe from one baby boomer to another. I'm going to say thank you right now for putting this in actual paperback and not making it an ebook, because I am so freaking sick of
Right.
reading stuff online and
the
looking at my
ebook comes in, it goes into your downloads, and when do you look at it? At least if you have this sitting on your desk or a table or something like that, eventually you say, let me take a look.
Yeah, right. No, I much prefer the real deal than the e-versions. Right. Yes. Anyway, Craig, this has been fantastic, and we really, really appreciate your insights. And thank you for being here and sharing all your wisdom. And just, again, all the listeners, I want to encourage you to go to Craig's site. Give us that URL again.
It's www.craigcodyandcompany.com/high return.
Excellent. Okay. And yes, we will put that in the show notes. And thank you again for being here. It's a pleasure having you. And we'll thank you for the listeners too. If you liked what you heard, give us a thumbs up, give us a 5-star on iTunes, or even just send us an email and tell us how amazing we are. We're always happy to hear from you. So thank you very much.
And thank you both very much for having me on today. Appreciate it.
Yep. Our pleasure. Thanks, everyone.
Bye.
Thank you.